So what's the difference between a trader and an investor? And I used to get these confused and think they were just like the same thing. And really, it's all about strategy when it comes to investing in the stock market, buying stocks. So before I go into exactly what the difference is, first thing that I want to say, we have to know exactly what buying stock is. Um, like what are you actually buying when you're buying a stock? So I want you to imagine, first and foremost, when you're buying a stock, you're actually buying a little piece of the company, right? And so the best way to illustrate this is, imagine that you have a friend who decided to start their own handyman business. And so they're working for themselves. They're basically self employed. They have a truck, they have tools, they go around to different jobs. They're doing random work at people's houses, right? And would it be fair to say that when this person, your friend, takes out a loan for his business, for his handicap business, for his handyman business, let's say that he needs a new lawnmower and he needs to get a loan because he's not profitable yet. The business just started. Well, him and him alone, he's the only one who's responsible for that loan, right? Nobody else, because it's his business, correct? And let's say that the business does really well and it becomes very profitable. Well, those profits are also his and his alone because he is the only owner of that business, right? So you take all the income that's coming in, you minus all the expenses and the loan payments and the debt for the business, and what's left over is either his profit or his loss, right? And so now imagine that that same handyman business went public on the stock market and decided. So this is what happens when you have shares, when you're buying stocks. A company goes public on the stock market, and instead of having the sole profit and the loss be attributed to one specific person who owns the business, they say, hey, this whole pie, usually I take it and it's all just mine. Instead, we're going to divvy it up into like 1,000 slices. And we're going to let you guys buy it. You guys can each buy a slice. This is what a stock is. So when you're buying stock in a company, you are literally buying a portion of the ownership of the company. And the reason I'm explaining this before going into what trading and investing the difference is because investors are literally investing in companies. Investors are they're buying a piece of that pie. They're saying, hey, I want a share of the ownership and I want to hold on to it because I believe in this company. And I think that this company is going to grow based off of the information that I have about it. And instead of actually running this business or starting a business like it, I would rather just buy a slice of this one and then let the people who are operating the business do their thing. And so this is what investors are doing. And they're doing it expecting, with the hopes of the company becoming more profitable, which makes their slice of pie more valuable. Now, traders have a different approach. And I'm not saying one is better than the other. It depends on your preferences. So businesses go up and down in value every day, depending on what's going on. Like, let's say that the handyman has to take out a loan to get a loan, has to take out a loan to get a lawnmower. But the day that he takes out that loan, his business is not as valuable because now it owes more money than it's making. So, like, you go get that loan. If that business had a pie like that, right, and goes and gets that loan, well, all of a sudden, the value of that pie is going to go down, right? And let's say that, but now he's operating with that new lawnmower, and he's getting making a lot more revenue because of it. And then people are like, well, it makes sense that, he got that loan because he's paying that loan off and he's in profit. So now the pie is going to be more valuable. The stock would go up. And so what traders do is they look at these different things and the fluctuations in the market, and they don't want to invest in a specific company. They want to just put their money in something before they think it's going to go up. And what they do is very short term, buy it when it's low, then it goes up, and then they sell it. And then they try to capitalize on those gains, and they're doing that all throughout the day. One is very, very active. If you're trading, you have to have your pulse on the market all day long, and you have to be ready to execute a trade basically at any given time. And I know they have softwares and AI tools and things like that to help them be able to do that. I don't really know. I'm not a trader. I like business fundamentals and business principles. So I look more at investing. I'm looking at companies, their balance sheets, what they're doing, how many quote unquote lawnmowers they're getting loans for, what their revenue looks like, and their trajectory over a period of time, because I would rather just buy little slices of pie and hold on to them and let them become more valuable over time. But that's basically the difference between a trader and an investor. Now, there's one more caveat of people who buy stocks, a third category, and these are a different way that you can invest in stocks and in the market, and that is investing for dividends. And so and this is just how I've come to understand this. I'm just sharing that. I'm not an expert in any of this stuff, by the way. I don't claim to be an expert. This is stuff that I'm learning, that I'm really interested in, and that I like talking about, and that I think about all the time. So I'm making content about it. And so, especially being a student of accounting, I really love business. Accounting is the language of business. And so it's really cool that I could look at public companies, look at their balance sheets, look at their income statements, and know what it means, and then be able to make decisions on what companies that I want to invest in based off of that. But anyways, so a dividend investor is somebody who is literally parking their money in a stock, because some companies, what they'll do is they give out dividends. And so what this means is that when you buy slices of their pie, right, the stock, they make excess profits. They reward the stockholders, which are basically the pie buyers, right? The people who've bought the pie, the people who have invested in the company. They reward them by giving them a dividend. And so usually the dividend is something like 5 or 6% of what you've invested in the company, and they'll give it out either like monthly, quarterly, yearly. It varies by company. But so some people look for stocks that specifically have high dividends. Let's say that, and this is usually people who've already been in the market for a while, or they have an excess of cash, and they want to get paid every month or every quarter, or whatever. And so they'll take their money, they'll put it into a stock, even if the stock looks like it's growing very slowly. You never want to put your money in a stock that's just going down. But even if it's flatlined for years, or it's growing very slowly, the pie isn't becoming that much more valuable. It is, maybe little by little, but not compared to other stocks. But this stock gives you a 20% dividend. Well, they're going to take that, because you put your money in there, because now you're getting a paycheck. It's like having a high yield savings account almost, but in the market. Um, where it's like you put your money in the market, and then that money stays in the market, but the company pays you month after month because you've your money in there. So when it comes to knowing what you want, what kind of investor you want to be, whether you want to be a trader, a dividend investor, or just a straight up investor, it depends on your personal goals. If you want cash flow right away, you need cash right away, and you have all the time in the world, well, maybe it would make sense to do some trading and some dividend investing. Do some trading, make some money that way. Of course, you're going to lose money doing that too, because you have to learn how to do it. And then when you do make money, then put it into other stocks that are giving you dividends. That's something that you might want to do, right? It all depends on you. I know for me, I don't have that much time. Like, I go to school full time, I have a family, I make these videos every day, every day right now, and that's my time, right? Other than like my free time, surfing and playing video games, hanging out with the family, doing fun stuff. So I don't want to be doing day trading. I don't want to be glued to my computer all day, seeing how stocks are doing. I was selling courses and coaching and consulting online, and I stopped doing it just because of how much time it took up. Yeah, I made money doing it, but my time became more valuable. And so in those courses, they had nothing to do with stocks, by the way. Don't have anything to sell you. Um, and so it really depends on what it is that you want and that your goals are when it comes to your investing. Which avenue that you should go down. I would say if you're brand new, like brand spanking new, and you don't really know anything about this, you've never bought a stock before ever, I would say my recommendation, and I'm reminding you, I'm not a financial advisor. This is just my personal opinion, and for entertainment purposes only, um, is to put some money into the S&P 500. Check out Vanguard's S&P 500. It's the ticker for it is VOO. So if you go to wherever you buy your stocks and type in VOO, and you'll see Vanguard's S&P 500 ETF, and it tracks the top 500 companies that are public, and the stock is based off of those. So you're not. It's like buying little tiny pieces of a lot of companies' pies. It's like you put money into there, and you're buying little pieces of the top 500 companies' stocks. And so it's like one of the most low risk things. And I recommended this stock specifically because it gives you, I think it's like a 1.5% dividend. So you still get to be a traditional investor and get a dividend, and and see what that process is like. You buy that, you hold on to it, just let it sit there and look at how it's fluctuating throughout the day, but don't sell it, just let it sit there. And then one day you check your account and you'll see a dividend deposit. And you're like, oh, cool, the company paid me because I invested. And you'll get to see how this works. Right. And then you can kind of make an informed decision off there if you want more stocks that are safe, that grow like the S&P 500. If you want higher dividends, or if you're like, hey, like just looking at the stock going up and down, I saw all this missed opportunity and I want to monitor that and I want to like really capitalize on that. Well, now you know that trading may be for you, but there's no right answer for which one is the best for you. There's just what aligns with you and your goals.